The one paperwork mistake that freezes benefits, and how to avoid it. The fastest way to stall an approval isn't a big transfer. It's a missing account, incomplete disclosure, leaving out one savings account, one small CD, one closed credit union account triggers a denial or a long, frustrating delay. Medicaid assumes, fairly, that if one thing is missing, more might be. That single gap opens the verification vortex, letters asking for proof, resubmits, and new deadlines you can't miss without starting over. Now, here's where most people mess up. They treat the application like a form. It's really a forensic audit. If something ever had your name on it in the last 5 years, expect to list it, prove it, or explain it with paper. Verbal explanations don't count. Screenshots don't count. Official statements, letters, and stamped receipts do. So let's make this easy. Build one asset packet and keep it current. A simple binder or accordion file works. Sections up front, copies behind each tab. Treat paperwork like leftovers. Label, date, and don't pretend mystery Tupperware is fine. If you wouldn't eat it, a caseworker won't accept it. Core sections to include identity, driver's license, social security card, birth certificate, green card if applicable, income, social security award letters, pension letters, annuity statements, last 12 months of pay stubs, if any, and tax returns if requested, assets, bank statements for all accounts, open and closed, covering the requested period, brokerage statements, CDs, money markets, cash value life insurance with current value and surrender charges, annuities, and any retirement account statements. Insurance, Medicare card, supplement or Advantage plan card, Part D, long-term care policy pages, current premium notices. Housing, deed, mortgage statement, home equity line statements, property tax bill, homeowner's insurance, utilities in your name, and an intent to return statement if applicable. Medical, physician letters, care plans, invoices for caregivers, durable medical equipment receipts, and transportation invoices. Legal, powers of attorney, financial and healthcare proxy, advance directive, and any guardianship or conservatorship orders. Contacts, a cover sheet with your attorney, caseworker, facility billing contact, and family point person. Date stamp everything you send. If you upload, print the confirmation page. If you fax, keep the transmission report. If you mail, use certified with tracking. Create a simple contact log. Date who you spoke with, what they asked for, and the deadline. Bureaucracy rewards the boring. Your goal is to make your file yawn-worthy. Now, the quick checklist most people miss. Pay stubs if working part-time. Social Security and pension benefit letters for the current year. Insurance cards front and back. Account numbers for every account that existed in the last 5 years, even if closed. Proof of closed accounts. Final statements showing zero and closure. Power of attorney with notarization, plus any required facility or state POA forms. Before you submit, do a reconciliation pass. List every account by institution and last 4 digits. Match each to statements in your packet. If something doesn't match, fix it now. A missing month on one account can kick your whole file back. Deadlines matter. When the state requests clarification, the clock starts. Put response dates on your calendar and set 2 reminders, 48 hours prior and morning of. If you need more time, ask immediately and document the extension. Common traps and fixes. Trap: you reported 2 bank accounts, but the statements show transfers to a third. Fix: add the third account, provide statements, and a brief note explaining its purpose. Trap: you listed life insurance, but no cash value page. Fix: request an in-force illustration or current value letter. Include surrender info. Trap: you submitted an intent to return, but no proof of housing costs. Fix: add property tax, insurance, and utility bills in your name. If you remember nothing else, remember this: completeness beats speed. A clean, fully documented packet saves months. And if your situation is complex, multiple accounts, home equity moves, caregiver payments, loop in an elder law attorney or benefits coordinator before you file. Their fee is often less than 1 month of private pay care. Paperwork's tight. Now let's build the legal shields that actually work. Legal shields that don't backfire. What to use when, why. Here's the truth about protecting the house and moving money to family. Tools work only when they're used early and correctly. Use them inside the look-back or without proof, and they backfire. So let's talk about what actually protects assets, when to use each tool, and why timing is everything. Start with the clock. Most shields require you to act at least 60 months before applying for long-term care Medicaid. That includes the big one, an irrevocable Medicaid Asset Protection Trust, often called a MAPT. Think of a MAPT as moving assets off your personal balance sheet to a box you don't control for daily spending, but you still choose who ultimately benefits. After the look-back passes, the assets in that box are generally not countable for eligibility and are better insulated from estate recovery. The catch? It must be truly irrevocable. You can't be your own trustee, and you can't dip into principal. If you peek, you pierce the shield. When a MAPT makes sense, you have a home or investments you want to protect, you're healthy enough to likely clear a 5-year runway, and you're comfortable giving up direct control over principal. When it doesn't, you need flexibility. You expect to spend these funds for yourself soon, or you're already inside the look-back with no runway left. A trust set up too late still triggers penalties. Timing isn't optional here. Next, spousal protections. If one spouse needs care and the other remains at home, Medicaid has rules so the community spouse isn't impoverished. States set a community spouse resource allowance, roughly a 6-figure amount the well spouse can keep, and allows certain monthly income protections. This is where a strategic resource split helps. Transfers between spouses aren't penalized, but they must be disclosed and aligned with state limits. An elder law attorney can map which assets stay with the community spouse, which gets spent down on value, and how to formalize a new budget that passes review. Home strategies. Your primary residence can be exempt during life if a spouse lives there or you declare intent to return and stay under the equity cap set by your state. But exemption during life doesn't stop estate recovery after death. That's why families use either an MAPT, a properly drafted deed plan, or a Caregiver Child Exception when it fits. The Caregiver Child Exception lets you transfer a home to an adult child who lived with you for at least 2 years immediately before nursing home admission and provided care that delayed placement. It's documentation heavy. Think calendars, physician letters, and evidence of care. Done right, it passes look-back without a penalty. Done casually, it gets denied. Life estate deeds sound simple. You keep the right to live there. Kids get the remainder. They can avoid probate and may limit recovery in some states, but watch the traps. If the home is sold during your lifetime, your life estate has value, and that slice can be countable or payable toward care. If the home is rented, net rents may be countable income, and you can lose flexibility if family dynamics change. For many, an MAPT provides more control options and better recovery protection, but it costs more to set up and still needs 5 years. Let's clear up. I'll just get a reverse mortgage. Reverse mortgages can clash with Medicaid planning. Draws are treated as loan proceeds, not income, but spending them without a paper trail can look like gifts, and the lien complicates later transfers or trust funding. If you already have one, disclose it and coordinate any plan before moving the title. Now, spend down that builds value. Instead of gifting, pay for medically necessary home upgrades. Ramps, grab bars, wider doorways, better lighting, dental, vision, hearing, mobility aids, and in-home safety. Replace worn-out essentials you actually use. Prepay funerals properly with irrevocable contracts. Pay down legitimate debt. Each dollar moves you closer to eligibility while improving daily life. And yes, document every invoice and write the purpose on it. Annuities and pensions. Immediate Medicaid-compliant annuities can convert excess assets into an income stream for the community spouse when structured to your state's rules. Irrevocable, non-assignable, actuarially sound, and naming the state as remainder beneficiary to the extent required. This is surgical. Misdraft it, and you create a penalty or an asset. If an annuity already exists, disclose it fully and get guidance on how it's treated in your state. Trusted team. Fewer landmines. This isn't a DIY sink install. One wrong turn and the basement floods. You want an elder law attorney who works Medicaid cases weekly, and ideally, a benefits coordinator embedded with your facility or community program. Ask in your first consult, what's our realistic 5-year plan? If I'm healthy, if I'm not, MAPT versus deed, which protects the home best in my state's recovery rules. How much can the community spouse keep? And what spend downs deliver the most value? Do we need a caregiver agreement now to legitimize family help? Are annuities or spousal transfers useful here? And who drafts them to state specs? What documents do I need to update today? POA, healthcare proxy, beneficiary designations. If you remember nothing else, remember this. Shields are powerful only when they're timely, verified, and boring on paper. Choose the right tool for your timeline, document every move, and let pros steer the state-specific rules so your protection plan doesn't become a penalty. Smart spend down without losing your shirt. Now that your legal shields are set, let's turn excess assets into eligibility the right way. The goal is simple. Trade dollars for documented value that improves your life and passes Medicaid rules. No gifts, no creative transfers. Clean receipts, clear purpose. Start with the biggest wins. Health and safety. Allowable spend-down categories typically include medical, dental, vision, and hearing. That means long-delayed dental work, crowns, implants when appropriate, new glasses and hearing aids with fittings, and warranties. These are high impact because they restore function and reduce fall and isolation risk. Pay providers directly, keep itemized invoices, and write medically necessary when it applies. Mobility is next. Rollators, wheelchairs, power chairs when prescribed, custom orthotics, and physical therapy copays all move you towards safer independence. Same principle. Provider invoices, proof of payment, and your doctor's order if available. If you need a vehicle that accommodates mobility, consult your attorney first. Some states treat a primary vehicle as exempt, and upgrading for accessibility can be a smart conversion when documented. Home safety is where the quick wins multiply. Think grab bars anchored to studs, non-slip flooring in bathrooms, threshold ramps, improved lighting in halls and stairs, lever handles, widened doorways, and railings you actually trust. Replace trip-heavy rugs with secured runners. If you've put off a failing furnace, electrical panel, or roof leak that threatens habitability, those repairs can be justified when you or a spouse live there or intend to return. Get licensed contractors, detailed estimates, and final paid invoices. Write the purpose on each invoice. Bathroom safety upgrade, fall risk reduction. That line answers questions before they're asked. Replace worn-out essentials you actually use daily. A supportive bed and mattress, stable seating with arms, shock-absorbing shoes, properly fitted dentures, and updated prescription lenses. Think function over luxury. New dentures beat new golf clubs. Medicaid agrees. If it improves health, safety, or documented care needs, it belongs on your list. Prepay essentials you know are coming. Irrevocable, properly structured funeral and burial plans are a classic, compliant move. Work with a funeral home to create an irrevocable contract. Keep the agreement and proof of payment. In many states, you can also fund burial spaces and modest markers for immediate family. Confirm local limits with your planner. Tighten documentation to make every dollar count. Pay vendors directly from your account. Avoid cash. On each invoice, add a brief note: who, what, why. Staple proof of payment to the estimate. File by category in your binder. This turns your spend down into an easy audit trail instead of a scavenger hunt. Mini case to show the math. A client had a $22,000 penalty risk from a poorly documented help to family. We paused gifts and redirected $18,500 into allowable spend downs: bathroom remodel for safety, hearing aids, dental work, and an irrevocable funeral plan. We gathered physician notes for fall risk, contractor invoices, paid receipts, and the funeral contract. The documented spend reduced countable resources cleanly. The attorney then prepared a brief explaining medical necessity and intent. Result: the penalty risk was neutralized, eligibility timeline restored, and daily life got safer. Common pitfalls and fixes. Pitfall: big box receipts that say home goods, no detail. Fix: ask for line item receipts. Attach photos and contractor notes showing safety modifications. Pitfall: paying a family member in cash for care. Fix: put a written caregiver agreement in place before payment. Set an hourly rate consistent with local market, log hours, and pay by check with timesheets. Pitfall: buying luxury items. Fix: keep purchases tied to health, safety, and basic living needs. Skip upgrades that look discretionary. Track every receipt. On each, write the purpose and the beneficiaries. Name, log date, vendor, amount, and category. At month's end, total the spend and keep a running balance of remaining countable assets. That prevents overspending and shows exactly when you hit the target. Finally, coordinate timing. Don't start spending until your attorney greenlights the plan and confirms current limits. Sequence bigger upgrades first, then fill gaps with medical and funeral items. Keep one cushion for pending invoices so you don't drop below thresholds and bounce back over them next week. Do this right and spend down becomes painless. You improve health and home, you hit eligibility cleanly, and your packet reads like a checklist the reviewer wants to approve. The house: what's actually safe and what isn't? Let's clear up the home confusion fast. Your primary residence can be exempt for eligibility if a spouse still lives there or you sign an intent to return and your home equity is under your state's cap. That cap varies by state and changes over time. So don't guess. Ask your attorney for the current number where you live. Exempt for eligibility, though, doesn't mean untouchable forever. After death,